Here to give us her take on the best and worst positioned is Erika Najarian, Senior Large Cap Bank and Consumer Finance Analyst at UBS. Erika, what's driving this? I know for a bank like Goldman, this is the second year now of really strong returns. So are we starting to get back to less interesting entry points or no?
So, you asked first what's driving it. It's really three things. Number one, it's deregulation. Number two, it's the return or the acceleration of activity levels, whether it's capital markets, which is clearly impacting Goldman stock, or lending and lending to middle market companies, hopefully into next year. And the third would be the dream of a steeper yield curve. And those are really the preconditions for outperformance. Now, can this continue? I think you have to be a little bit selective in how you ride the momentum into 2026 because it is rare. It is rare that bank stocks outperform the S&P for 2 years in a row. And when they do, it's typically when they come out of recessionary periods. So they're coming from much, much lower valuation points. The only time they outperformed in a non-sort of recovery scenario was 94 and 95. So we'll see if we'll have that kind of sort of unicorn 2 years for the stocks.
Right. And Bank of America is one of your picks for next year. So is Capital One and Huntington. Tell us why.
Sure. So for Bank of America, the valuation is still undemanding. And you get all of the things that I mentioned, dereg, exposure to a steep curve, and the acceleration activity levels in both the lending side and capital market side for a more reasonable valuation that you're seeing in a JP Morgan, for example, Morgan Stanley or Goldman Sachs, without really sacrificing quality. Capital One, in my opinion, is a multi-year story. Keep in mind that while it's very tethered to the consumer, they have actual competitive advantage in that they're one of one in terms of being both a debit issuer and a network in the United States and one of four global credit card networks around the world. And for Huntington, look, I think the message for me too here is that the regional banks have not participated in the rally as much as the money centers have. And I think it's time for them to shine in 2026. So Huntington is one of the best positioned banks. It's done 2 deals in Texas already. It has outsized growth relative to peers, and it's got a great management team.
Erika, first of all, it looks like you're really primed there for Christmas. I'm looking at the tree, and you got the wreath,
beautiful,
and the stockings on the fireplace. It looks awesome. But here's my question, and it's a two-parter. What's the deregulation worth to the banks, and is it worth more to the smaller banks than the bigger banks?
So the deregulation is worth about 150 basis points near term in returns. Wow. Now, we're in a very commoditized business, and Jamie Dimon loves to paraphrase Jeff Bezos, your margin is my opportunity. Mm-hmm. So that's sort of a short-term opportunity for ROE. However, what's very different, Steve, in this administration versus last is a lot of the dereg has actually focused on the money center banks. Right. So under Trump 1.0, it was very regional bank focus, and this time around, it's big bank focus. And that's why the gap between, book valuation and future ROEs is wider with the money center banks because they're anticipating a much steeper improvement in returns on equity.
Okay, here's the most complicated question I think I can ask on national television. You ready?
Ready.
I happen to know, having covered this dismal industry for a very long time, that banks do not want to merge because they don't want to reach a regulatory cap. In other words, don't get bigger than X because then you're subject to worse regulations. Under the Trump administration and the new regulatory regime at the Fed, is that any longer a constraint? And as a result, could you expect to see potentially some bigger mergers that put some of the bigger regionals together that now might require or necessitate or otherwise attract a premium because of those mergers?
Can I be a little bit of a Grinch this
Please.
Christmas? Do you know why banks don't merge? Because you could be like the king of your country club, make tons of money, and be one of 4,000 banks and not be under scrutiny, right? Banks are sold and not bought. So there hasn't been a significant motivation, right? Because you can, make a decent amount of money and whatever. So that's just me being Grinchy. But to your question, I think that investment bankers are not having a fun Christmas. I think you could see big sweeping announcements in the first quarter and in the second second quarter of next year. Why do I say it's front loaded? Because you do have the midterms coming up, right? And while the administration's permissiveness in terms of large deals should last through the duration of the presidency, there's still a little bit of hesitation in terms of doing large sweeping deals if you're going to get yanked in front of Congress and, asked to explain that deal.
So,
But I do think, by the way, all of those sort of limitations that would sort of cap your desire to grow is part of the deregulatory construct, right? They're trying to get rid of those sort of, false levels where you're saying, okay, I
right.
can't reach 700 billion because then I will have much
So
more.
we have to go,
Yes.
Erika, but I just want to make sure I understand. You're saying that the first half of next year could see some bigger bank mergers because they're trying to get in before the elections and make use of the greater regulatory permissiveness, I guess, of the administration is what you're saying.
Huge.
Good.